Hi, welcome back to John Smith O2. Today we're talking about something happening in the physical silver market that a lot of everyday investors are noticing for the first time. And it's honestly one of those situations that makes you stop and ask what's really going on beneath the surface. Dealers across the country are paying premiums as high as $20 over the spot price for certain silver coins, specifically the Mexican Libertad. Let that sink in for a second. Spot price is supposed to be the benchmark, the number everyone watches, the number that tells you what an ounce of silver is theoretically worth right now. But when dealers are willing to pay $20 above that number just to get their hands on physical coins, it tells you that the paper price and the real-world price are starting to tell two very different stories. Now, this is important because for years, most people assumed the spot price was basically the final word on what silver is worth. You'd check the number, multiply it by the ounces you own, and that was that. But what's happening right now with the Libertad buyback premiums is exposing a gap that's been quietly widening for a while, and once you understand why this gap exists, you start to see the silver market in a completely different light. Let's break this down from the beginning. The Mexican Libertad is a silver coin minted by Mexico's official mint, and it's known for a few specific things. It doesn't carry a fixed face value the way some other government coins do. Its design changes slightly from year to year, and it has a long-standing reputation among collectors and stackers for being one of the more elegant and trusted silver coins in the world. For a long time, Libertads traded at a modest premium over spot, similar to other well-known coins like the American Eagle or the Canadian Maple Leaf. Nothing dramatic, just a normal markup that reflects minting costs, distribution, and dealer margins. But recently, something shifted. Dealers haven't just been selling Libertads at a premium, they've been actively buying them back from customers at premiums that are unusually high, sometimes reaching that $20 over spot mark. Think about it this way. Imagine you own a used car, and normally when you sell it back to a dealership, they offer you less than what a brand new one costs, because that's just how resale works. Now imagine the dealership suddenly starts offering you more than the price of a new one just to get your used car back. That would immediately raise a question in your mind. Why do they want it that badly? That's essentially what's happening in the silver market right now, and the answer comes down to physical supply. When we talk about the price of silver, most of what we see quoted on financial websites and in the news comes from paper markets, primarily futures contracts traded on exchanges like COMEX. These contracts represent silver on paper, agreements to buy or sell a certain amount at a certain price at a future date. The vast majority of these contracts are never actually settled with physical metal changing hands. They're financial instruments traded by institutions, funds, and speculators, and they set the benchmark spot price that everyone references. But physical silver, the actual coins, bars, and rounds that you can hold in your hand, operates in a completely separate market with its own supply and demand dynamics. And right now, there's growing evidence that the physical side of that market is tightening. When dealers are willing to pay well above spot just to reacquire coins like the Libertad, it usually means their own inventories are running lean, and they're having a harder time sourcing new supply from mints and wholesalers to meet the demand from their customers. Here's what this means in practical terms. If you walk into this situation without understanding it, you might look at the spot price and think silver is trading at, let's say, $35 an ounce, and assume that's the true cost of getting your hands on physical metal. But then you go to actually buy a coin, and you find out the real price, premium included, is closer to $50 or even $55 an ounce for certain products. That disconnect confuses a lot of new investors, and honestly, it confuses some experienced ones too, because we've been trained to think of spot price as the single source of truth. Now this is important because this pattern isn't happening in isolation. It's part of a broader story that's been building in the silver market for a while now. Silver isn't just a monetary metal that people buy as a store of value. It's also a critical industrial metal. It's used extensively in solar panel manufacturing, in electronics, in electric vehicles, and in a wide range of technologies that are only becoming more common, not less. Every year, industrial demand for silver eats into the available above-ground supply, and mining production hasn't been able to keep pace with that demand for several consecutive years now. When you combine strong industrial demand with steady investment demand from people who want physical silver as a hedge against currency devaluation or economic uncertainty, you end up putting real pressure on the amount of metal that's actually available to be minted into coins and bars. Mints can only produce as fast as they can source raw silver and run their production lines, and when demand spikes unexpectedly, there's a lag before supply can catch up. So when we see dealers paying extreme premiums to buy back Libertad specifically, it's worth asking why that particular coin. Part of the answer is that the Mexican mint doesn't always produce Libertads in the same volume as coins like the American Eagle, so when demand rises, the available pool of Libertads on the secondary market becomes an important source for dealers trying to fill orders. If new production is limited or delayed, dealers turn to buying back existing coins from the public just to keep their shelves stocked, and that competition for existing inventory pushes buyback premiums higher and higher. Think about it this way. If a bakery can't get enough flour from its usual supplier and people still want bread every single day, that bakery might start buying back day-old bread from customers at a higher price than they originally sold it for, just so they have something to offer the next customer who walks through the door. It sounds strange on the surface, but it makes complete sense once you understand the supply problem underneath it. Now, I want to pause here and remind you, this isn't financial advice, and I'm not telling you what to do with your own money. What I am doing is walking you through the mechanics of what's happening so you can understand it clearly and make your own informed decisions. If you're finding this breakdown helpful, consider subscribing to the channel because we cover these kinds of market shifts regularly, and it helps to have context before headlines start throwing numbers at you without any explanation. Let's go a little deeper into why this premium gap matters beyond just this one coin. When physical premiums rise sharply while the spot price stays relatively flat, some analysts view it as an early signal that physical demand is outpacing physical supply, even if that pressure hasn't fully shown up in the official price yet. It's a bit like watching water build up behind a dam. The visible surface might look calm, but the pressure underneath is increasing, and eventually that pressure has to go somewhere. Historically, we've seen moments like this before, though every situation has its own unique details. During periods of economic uncertainty or when confidence in paper currencies wavers, more people tend to seek out physical precious metals as a way to protect their savings. When that happens all at once, dealers can get overwhelmed with buy orders while their physical inventory struggles to keep up, and premiums spike as a natural market response to that imbalance. At the same time, it's worth acknowledging the other side of this conversation. Not every premium spike means a massive supply crisis is coming. Sometimes premiums rise temporarily due to short-term logistics issues, shipping delays, minting schedule gaps, or simply a wave of demand from one particular retail trend that eventually cools off. Markets are complicated, and it would be irresponsible to look at one data point, even a striking one like $20 over spot, and immediately jump to dramatic conclusions. The honest answer is that we're watching a real and interesting shift, but nobody can say with certainty exactly how it plays out from here. Here's a simple mental framework you can use to think about this going forward. Picture the silver market as having two layers. The top layer is the paper market, the futures and spot price you see quoted everywhere, driven largely by trading activity, speculation, and macroeconomic expectations. The bottom layer is the physical market, the actual metal, moving between mints, dealers, and individual buyers, driven by real-world supply constraints and tangible demand. Most of the time, these two layers move roughly in sync, and the gap between them stays small and unremarkable. But every so often that gap widens, and when it does, it's usually the physical layer trying to tell you something that the paper layer hasn't caught up to yet. What we're seeing with these Libertad buyback premiums might be exactly that kind of signal. Dealers aren't guessing when they set these premiums. They're responding directly to what they're experiencing in real time, how hard or easy it currently is to source coins, how many customers are calling in wanting to buy, and how much competition they're facing from other dealers trying to secure the same limited inventory. In a sense, premiums act like a barometer for physical market stress, even when the official spot price doesn't move much at all. Now let's talk about what this could mean going forward, while keeping a balanced perspective. If industrial demand for silver continues climbing, particularly from the solar and electric vehicle sectors, and mining supply continues to struggle to grow at the same pace, this kind of premium pressure could become more common rather than less. On the other hand, if global economic conditions shift, if interest rates move in a direction that reduces investment demand for precious metals, or if mints ramp up production to meet current demand, some of this premium pressure could ease over time. Both outcomes are genuinely possible, and that's exactly why staying informed rather than reactive is the smarter approach. It's also worth mentioning that this situation highlights something valuable for anyone who already owns physical silver or is considering it. Understanding the difference between spot price and real transaction price, meaning the price you'd actually pay to buy or actually receive to sell, gives you a much more accurate picture of what your metal is genuinely worth in the real world. Spot price is a useful reference point, but it's not the full story, especially during periods like this one, where premiums are moving independently. Let's connect this back to real life for a moment, because at the end of the day, this isn't just an abstract market curiosity, it touches real financial decisions that people make. If you're someone who holds physical silver as part of your savings or your long-term financial planning, these premium shifts directly affect what your holdings are worth if you ever needed to sell, and they affect what it would cost you to acquire more. Being aware of these dynamics helps you avoid confusion, helps you ask better questions when you're dealing with a dealer, and helps you understand headlines about silver prices with a lot more context than the average person watching the news. It also serves as a reminder that markets, especially commodity markets tied to both industrial use and monetary history like silver, don't always move in straight lines or make intuitive sense at first glance. There are layers to understand: paper markets and physical markets, official prices and real-world premiums, short-term noise and longer-term structural trends. The more comfortable you get untangling these layers, the better equipped you are to make sense of what's actually happening, rather than just reacting to a single number on a screen. So where does that leave us right now, in the middle of 2026, watching dealers pay unusually high premiums to buy back Mexican Libertads? It leaves us with a genuinely interesting data point, one that suggests physical silver supply and demand dynamics are tightening in ways that aren't fully reflected in the standard spot price yet. It doesn't guarantee any particular outcome, and it's not a call to panic or rush into any decision. What it does deserve is your attention, your curiosity, and your willingness to keep learning how this market actually works underneath the surface. To summarize everything we walked through today, dealers offering premiums as high as $20 over spot for Libertads points to real friction in sourcing physical silver coins, something that traces back to a combination of strong industrial demand, steady investment demand, and mining supply that hasn't kept pace with either. This premium gap between paper spot price and real-world buyback price acts almost like an early warning signal, showing where physical market pressure is building, even if the official price hasn't fully caught up. Whether this trend intensifies or eases over time remains to be seen, and reasonable people can view the future differently based on how they weigh industrial growth, monetary policy, and mining output going forward. I appreciate you spending this time with me today, walking through what's really going on behind these silver premiums. If this kind of clear, grounded breakdown is useful to you, subscribing helps a lot, and it lets you stay ahead of these shifts as they continue developing throughout the year. Thanks for watching, take care of yourself, and I'll see you in the next one.